All right, thanks everyone for reading through those disclosures. As I said, my name is Natalie Beckett, and I will be your moderator this afternoon for another one of Avant-Garde Trading's free educational webinars. This afternoon, we are glad to have Chuck Hughes with us. He is the 8-time winner of the International Trading Championship, and he's going to talk about stock and option spread trading with you guys. Chuck, are you with us?
Yes, can you hear me?
Yes, I can, loud and clear. You sound great.
Okay, good.
So great to have you. Thank you for being here. And I just want to let everyone know, if you guys have questions throughout the webinar, please feel free to put them in the chat or Q&A box, and I will try to field them over to Chuck, as best I can, or if time allows. And if we can't get to all of your questions, we'll try to do so at the end of the webinar if there's time. All right. So with that, Chuck, I'm going to go ahead and give you the reins, and you can get started.
Okay, sounds good. Let me share my screen now.
Yep, coming over to you right now.
Okay, good. Okay, I'm going to go into slideshow mode here. And can you see the slides okay?
Yep, yes I can. Looks
okay.
Great. Take it away.
Okay, great. Thank you, Natalie. It's great to be here today, everybody. And today we're going to talk about stock and option spread trading. And we've been using these strategies for many years. And the spread trading has really worked out well over the last 2 years, where the markets in general have not really trended well over the last couple of years, and a lot of volatility in between. So it makes it very difficult to make money on directional trades. So we're going to talk today about our spread trading with stocks and options, and that works a lot better in the current market environment where we have very little trend and a lot of volatility and a lot of sector rotation. So we'll discuss the advantages of option spreads versus directional trades. And of course, when you buy a stock, it must increase in price in order to profit. And when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll incur 100% loss of the option premium. So when you're trading options and you buy a call option, let's say, you're always faced with the possibility of 100% loss of that premium. Here's I took a snapshot of Facebook option chain recently. Facebook was trading at 132.07, and if we were going to buy the 135 strike call, this option is about 1 month out. So if we're going to buy the 135 strike call, we'd pay $3.15 to buy the 135 strike call, and at option expiration, in this case about a month out, Facebook stock, the underlying stock, would have to close above 135, which is the strike price of that call we looked at, or you would incur 100% loss of that $315 premium. So when you're trading options, you're always faced with that possibility of a 100% loss. And our screening program that you'll see today, the goal of that, of course, is not to incur those big losing trades when you trade options. Otherwise, you can really get knocked out of the game pretty quickly. So here's a daily price movement of the S&P over the last couple of years. And as I mentioned, not much trend, a lot of volatility. You can see all these declines here. You know, if you entered a call option trade and your timing was bad, you could easily get stopped out in this kind of a market. So that's the disadvantage of directional trading. This is the daily price movement of the VIX index, which is kind of like a mirror image of the S&P. Every one of these spikes you see here represents a sell-off in the stock market. So if you were long a call option during any one of these sell-offs, which is represented by these spikes, you could easily get stopped out of your position. So we like to trade stock and option spreads, and a stock spread can profit if the stock increases in price, decreases, or is flat. at option expiration. So that's a big advantage over just a directional trade that the stock has to increase in price or you lose money. And with option spreads, they can profit if the underlying stock increases, decreases, or is flat at option expiration. So that's a big advantage over directional trades when you can profit if the stock is up or down. So let's look at our Prime Trade Select system. We use this system to select stock and option directional trades. We'll look at our trade selection first, and then we'll look at some examples of directional trades we took. And then one of our money management rules is when we have a profit in a directional trade, then we create a spread trade. And that's really worked out well the last couple of years because these spread trades have been profiting during this type of market condition. So once we enter a directional trade, whether it's a stock or option directional trade, we have three money management rules. The first rule is we exit losing trades quickly before they turn into a large loss, and we don't exit winning trades with a small gain. So that's also an important part of trade management. You know, as soon as you get a gain, a lot of people want to take it, but you don't want to take you don't want to exit winning trades with a small gain. And then, of course, we use options to protect profits. When we have a profit in a directional trade, we use options to protect those profits by creating a spread trade. This is just a recent listing of some closed out trades in our option portfolio, and these are for Apple, Amazon, Home Depot, Netflix. And what I did was I calculated the average losing trades that you see here versus the average winning trades. And the average losing trade in this portfolio of closed out trades was a 14% loss. And we like to exit our losing option trades before we incur a 20% loss. So in this example, we had an average loss of 14% on our option trades, but our average winning trade was 136%. So we don't exit when we have a small gain in an option. We'll hold on to it. And on the other hand, if we have a losing trade, we'll exit that quickly before it develops into a large loss. So in this case, our average loss was 14%. So those are just examples of our money management rules in action. And in this example, we only need to win on 1 out of every 8 trades in order to profit. So because our winning trade, 136%, average winning trade was so high, we only need to win on 1 out of 8 trades in order to profit in this example. So if you incur a 20% loss on an option, it takes a 25% return on your next trade to break even from that trade. But if you incur a 50% loss, it takes a 100% return on the next trade just to break even. And how many 100% winners have you had lately? So the point is with this money management is to cut your losing trades short pretty quickly and to let your winning trades run. And of course, if you incur a 75% loss on your option, then you need a 300% return on your next trade just to break even. So if you limit your losses on an option trade to 20%, you can survive and then move on to the next profit opportunity. And we normally use, for a stock trade, we'll use a 5 to 7% stop loss. And with an option trade, we look to start getting that out to exit the trade with a 15 to 20% loss on the option. And whenever we have a profit in a stock or an option trade, then we use options to create a spread trade to protect profits. And stock spreads, there's 2 types of stock spreads. We'll show you examples of that in a minute. With stock spreads, you can profit if the stock increases, decreases, or remains flat. And with option spreads, you can also profit if the underlying stock increases, decreases, or is flat. And establishing a stock spread trade can even guarantee that you'll have a profit for your stock trade, and establishing an option spread can even guarantee a profit for your option trade, and we'll show you some examples of those.
Chuck, I'm
yes.
sorry to interrupt. We do have a quick question. Cecile White is asking, is your 20% loss stop on directional trades or on your credit spread trades?
That's a good question. It's on the directional trades.
Okay, thanks, Chuck.
Yep, okay. And okay, so we'll look at actual trade examples that demonstrate how a spread can guarantee a profit for your stock or option trade. So we actually trade these spreads. I can show you examples of trades that we took, both stock and option trades that we took, that were guaranteed to have a profit on the trade no matter what happens to the underlying stock. So let's first look at stock trade selection. Now this is for a directional trade. So when we're going to enter a directional trade, we have a stock selection process we go through, and we like to use trend following. And if we use trend following, that allows us to follow the current price trend of a stock instead of trying to predict the future price movement. So we're trend followers. It's worked very well for many years. And if you use a trend following system, that eliminates emotional decision making and instead gives us the discipline we need to be successful traders. And our trade selection process, trend following trade selection process, works both in bull and bear markets. And during the 2002 and 2008 bear markets, we were heavily short equities and commodities and currencies. So the trend following works both ways, and we used it in 2002 and 2008 successfully when we were heavily short. So let's look at the two rules we use to select directional stock trades. The first rule is we want to determine the price trend of a stock using the 50 and 100-day EMA, exponential moving average. And then step two is we want to select a low-risk entry point using the Keltner channel. So we use the 50 and 100-day exponential moving average to determine the price trend. And if the 50-day exponential moving average is above the 100-day exponential moving average, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. And as I mentioned, the trend following works in both bull and bear markets. And in bear markets, instead of buying stocks, we buy bearish ETFs. And here's an example of a buy signal with the 50 and 100-day EMA system. And this is a daily price chart for Starbucks. The red and black lines are the vertical lines are the daily price movement. And the blue line here is the 50-day EMA. The red line is the 100-day EMA. So we can see back in November, the blue line crossed above the red line, and Starbucks was on a buy signal. And as long as the 50-day EMA is above the 100-day EMA, then the stock remains on a buy signal. Here's an example of the sell signal for FXI, the Chinese stock ETF, and these red and black lines are the daily price movement. We can see right here that the 50-day EMA, the blue line, crossed below the 100-day EMA. So at that point, the FXI was on a sell signal, and as long as the 50-day is below the 100-day, then the FXI is on a sell signal. And you can download these, the 50 and 100-day EMA on stockcharts.com. Okay, and the second step in selecting a stock directional trade is to select a low-risk entry point using the Keltner channels. And the Keltner channels act as an overbought, oversold indicator. And when a stock is trading near the upper channel, it's becoming overbought, and it will normally retrace to the middle or lower channel. So what I did is I circled the points where the stock was trading near the upper channel and it was getting overbought, and you can see each time that it got overbought, it retraced, overbought, retraced, overbought, retraced. So when a stock is trading near the upper channel, it's getting overbought. When it's trading near the lower channel, it's getting oversold. So we can see that when it gets overbought, it normally retraces, and then when it gets oversold, it normally rallies. So we can see oversold rallies, oversold rallies, oversold rallies. So we use the Keltner channels to help us time our entry, and we don't want to buy when the stock is trading near the upper channel. We want to wait till it retraces towards the middle or lower channel. So we're going to look at a few trade examples, and we're going to show our actual brokerage transaction reports, and we'll circle the day on the chart that we bought the stock, and you can see that the Keltner channels allowed us to select low-risk entry points for our stock directional trades. So, and the thing to notice with these price charts is how the stocks rallied after we purchased them. So by using the Keltner channels, we were able to get a low-risk entry because the stocks didn't retrace much from our entry point. So here's one for the Vanguard Real Estate Investment Trust. We bought 600 shares of VNQ right in here, and you can see it had a pretty good rally after that. And we have an open trade. This is our stock portfolio here. We have an open trade profit in VNQ of $27,000. Here's another example. This is DVY. This is the dividend ETF. We bought 400 shares of DVY 8157 right in here. Now it did retrace a little bit right here, but you can see that it went on to new highs, so this allowed us to get a profitable entry buying it when it retraced towards the middle channel.
Chuck, we do have one other quick question, if you
yes.
don't mind. Anthony is asking, is the Keltner channel the same as the Bollinger Bands, and if not, how are they different?
Yes, the Keltner channels are very similar to the Bollinger Bands. The Keltner channels use the average true range, and I found them to be just a little more accurate for helping us enter trades than the Bollinger Bands. You could probably use both, but we just found over the years that the Keltner channels using the average true range are a little more accurate for our purposes of timing our entries. So you can see with DVY, the dividend ETF, we have a $18,000 open trade profit. Here's another example. This is for the XLU, the utilities ETF. We bought 1,000 shares at 46.26 right in here, and then it rallied up in over $50, and so using those Keltner channels allowed us to get a low risk entry, and we have a $16,000 open trade profit on XLU. So the Keltner channels in these examples resulted in low risk entries as the stocks did not retrace much from our entry point, and this helped us help prevent getting stopped out of our stock position. Okay, let's look at the first type of stock spread, and we have the three money management rules that we mentioned. We exit losing trades quickly before they turn into large losses. We don't exit winning trades with a small gain, and then we use options to protect profits with winning trades by creating a spread. So we're looking at this third money management rule. When we create a spread trade, we're protecting our profits by using options. So the first type of stock spread trade we'll look at are covered calls. And we trade both monthly and weekly covered calls. Today we're just going to look at the weekly covered calls due to our time restraints. So we're heavily involved with selling option premium with weekly covered calls, and we also trade the monthly covered calls, but we'll save that for another presentation. So with a covered call, of course, you buy 100 shares of a stock or an ETF, and then you sell a weekly call option. And when you sell an option premium, cash is credited to your brokerage account. So each week when we sell these weekly premiums, there's cash that goes into our account each week, and that goes immediately into your account after you sell the call option. So if you were to sell an option, let's say with a 4-point premium, then $400 in cash gets credited to your brokerage account. So this cash credit reduces the cost basis of the stock and reduces the overall risk of the trade. So whenever you sell these premiums, you're reducing the cost basis of your stock. And selling weekly options allows us to compound our returns, because each week we receive this premium in cash, and that allows us to, over time, to compound our returns. So selling weekly option premiums can lead to a 100% cash-on-cash return regardless of the price movement of the underlying stock. So once you sell an option premium, that cash goes into your account. You get to keep that cash no matter what the underlying stock does. So in all cases, you keep that cash that's credited to your account. So if you invest $4,000 to buy 100 shares of, let's say, an ETF, over the course of a year, you could receive $4,000 in cash income. And I'll show you some examples of that. And these weekly covered calls, we've been doing these since weekly options were created, and they can profit in any type of market condition, and there's less risk involved with covered calls than there is with just owning the stock or ETF outright. So weekly options start trading on Thursday, and then they expire the following Friday. So they have a trading life of 6 trading days. There's 52 opportunities each year to sell option premium, and this allows us to, when we roll over our options each week, that allows us to compound our returns, because each week we're collecting cash. So let's look at an actual example. I have 100 shares of ERX. That's the energy leveraged ETF. So I own 100 shares of ERX in my account, and then each week I sell a weekly option premium, and on Friday I close out the expiring weekly option and then sell to open the new weekly option. So here's so when we roll over the expiring option, that allows us to keep the stock or the ETF in our account, so we won't be called out. So we like to close out the expiring option. That way we get to keep the ETF or the stock in our account, and we sell the new option. Here's an actual example. This is a spread trade I used, and I was buying to close the September 16 weekly call. So this is an actual spread trade that I put in. So I was closing out the September 16 weekly call, and then I was selling to open the September 23rd 29 strike call. So closing out the September 16th and then selling to open the September 23rd. So you can see these are weekly options as they expire on the Friday of the week. So September 16th was a Friday, September 23rd was the next Friday. So I use these spread trades, and I can save on the commission and then the bid-ask spread for the option. So normally roll over using a spread trade and close out the expiring option and sell to open the new option. And here's so I was selling the September 23rd, and here's my actual fill right here. Sold the September 23rd, 29 call at 114. So when I sold that call, you can see $105 was in cash was credited to my brokerage account. That's that green number right here. So that's after commission. So sold the option at 114, $105 in cash was credited to my account. And again, I get to keep that cash no matter what happens to the price of ERX. So let's project out here. Let's say you were going to buy ERX, buy 100 shares of ERX, and then start selling weekly call options. The cost to buy 100 shares would be $2,912. So I collected $105 in cash. So if you divide that weekly premium by the cost, that works out to be a 3.6% weekly return, cash return on my initial investment of $29.12. And here's a listing over the last 8 weeks of the ERX premiums I sold, and I sold a total of them. This shows the weekly calls here. I sold September 2nd, September 9th, September 16th, and over here the green amount is the cash that went in my account. So sold 8 of these weekly calls, and I collected $964 in cash after commissions. So that averaged out to $120 per week in cash income. And if you multiply 120, if we were able to collect a similar premium each week, then if you multiply 120 by 52 weeks, you would collect $6,265 in cash over the course of a year. And of course, if you divide that $6,200 in cash, potential cash income by your initial cost of $29.12, that works out to a 215% cash on cash return over the course of the year, no matter what happens to the price of the ERX. So if you receive a 215% cash on cash return, a lot can go wrong and you're still going to make money. The underlying stock or ETF could decline substantially and you could still profit. Or if you had bad timing and when you enter the trade, you could still profit. So there could be volatile price swings in the underlying stock or ETF, and you could still profit. So this gives the weekly covered call strategy a big advantage over a stock directional trade that requires the stock to move up in price, or you're not going to make money. And it also can help you prevent getting stopped out of the trade because you're collecting that cash income, which acts as a buffer and can help prevent getting stopped out of your trade. So also over the course of the year, if you're rolling over these options each week and you collect this much money, you can buy more shares of ERX and sell more option premiums, so you can start compounding pretty quickly when you sell these weekly option premiums. Here's another example.
Oh,
yes.
Sorry, Chuck. Don't mean to interrupt, but we're getting actually a lot of questions about this from multiple different people asking about when they should be exiting the trades. What day do you sell? How do you know which strike price to sell? We're getting multiple questions about that. So
okay, that's a good question. We roll over on Friday, so we close out the expiring call option on Friday, and then we sell to open the new call option on Friday. And we normally do it at the money. The options that we sell are normally at the money. And the nice thing about the weekly options is if you're busy on Friday, you can always roll over on Thursday. You can close out the expiring option on Thursday and sell to open the new option on Thursday. So if you're busy on Friday, and sometimes that happens, and you can't trade, then you just roll over on Thursday instead. Here's one more example. This is FAS, and I own FAS in my account. That's the financial leveraged ETF, and here's an actual spread trade I used, and this was on a Friday. We were rolling over, And so we were closing out the September 16th 29.5 strike call, and we were selling to open the September 23rd 28 strike call. So by using this spread trade and closing out the expiring option and selling to open the new option, I was able to keep the FAS in my account, and it wasn't called out. So we normally just hold the stock or the ETF in our account and roll over on Friday to prevent from being called. And I sold the FAS September 23rd 28 call at 111, and then after commissions, $102 in cash went into my account, and FAS was trading at 28.31. So if you divide the $102 in cash it received, that's a weekly return of about 3.6%. Here's a list of the 8 most recent premiums I sold, weekly premiums I sold, and these amounted to, after commission, $688 in cash, and that averaged out to $86 a week in cash income, and that's about a potential 154% cash on cash return if I divide the 4,477 potential income by the initial cost of around $2,900. I have 154% cash on cash return. So again, a lot can happen if you're collecting that much cash, and you can still profit. So we've been trading these weekly options now for several years since the weekly options were created, and it's a good basic income strategy and works in any type of market. Let's look quickly at the second type of stock spread, and that's married puts. And again, with our 3 trade management rules, if we have a profit in a stock directional trade, then we'll use an option to protect those profits. And in this case, we're looking at the second type of stock spread, and that's married puts. And the married puts are created by purchasing 100 shares of stock and then purchasing a put option, and we normally purchase an at-the-money put option. So you can initiate this spread simultaneously by buying the stock and buying the put simultaneously, or you can leg into the spread. If you buy a stock and you have a directional trade that makes money, then at a later date, to protect those profits, you can leg into the spread by buying the put option. That's the way we normally set these up. So, and I trade these in my retirement accounts as well as the weekly covered calls. With married puts, the put option limits your risk. So if the stock is trading at $53 and you buy the 50 strike put, the value of the stock cannot go below 50. So once you buy that put, it locks in a value, a floor underneath that stock, and the value cannot go below the strike price of the put that you bought. So when you buy a put, of course, your profit is not limited or capped. So if the underlying stock keeps going up, you keep profiting if you buy a put option. So it doesn't limit the upside potential. Here's daily price movement, Amazon stock right here, and we can see it was on a buy signal. The 50-day EMA, the blue line, was above the red line. I waited until it retraced right here towards the middle channel, and I went ahead and bought 300 shares of Amazon at 449.01, and we can see that it rallied after this entry right here. It rallied in price, so I got a low risk entry, and then I had after this rally in the stock here, I went ahead and bought the 515 strike put option. So I had a profit in Amazon stock, and I was just following the money management rules to protect those profits. So I bought 3 of the 515 strike puts at 53.13. So the value of Amazon stock cannot go below 515 when I buy that 515 put. So as it turned out, after I bought the put, Amazon did, there was a sharp price decline in Amazon, but I had already locked in a profit by buying that put option, and that allowed me to profit no matter what Amazon's stock did at that point, because the total cost of the put in the stock, the total cost was 502 points, and my minimum profit was, or my minimum price I could sell Amazon was 515 because I bought the 515 put. So I was guaranteed, with a cost of 502 and a guaranteed value of 515, I was guaranteed a profit on this trade. So we'll look at some other examples of married puts over different time periods. We've been doing this for a long time. This is before Apple even had its stock split. We bought 200 shares of Apple, average cost of $339, and then we bought the 560 strike put at $43.50, and we developed a series of calculators that will calculate the profit potential for option trades, and we use these calculators before we enter the trade, and they'll give us the profit loss potential based on the price movement in the underlying stock. In this case, this is the married put calculator. Bought the Apple stock at $339.05. Bought the 560 strike put at 43.5. And what this will do is calculate the profit potential based on price changes in Apple stock. In this example, from an 80% increase in the stock to 100% decrease in the stock. And this bottom row here will give us the percent return for this trade, and the second from the bottom gives us the dollar profit. So for each one of these spread trades, we can see if Apple stock was flat at $339. Remember, I bought it at $339. If it was flat at $339 at option expiration, I'd realize a $17,745 profit and a return of 46.4%. So the put locked in a profit for us, and no matter what happened, even if it goes down 40%, 60, 80, 100%, we're still going to realize that 46% return. So in this case, by buying the put, we locked in a guaranteed return for our stock. And when you do that, once you buy that put, you don't have to worry about earnings reports or bad overnight news or anything like that. You don't have to worry about potential bear markets. You can just place the trade and forget it, because you're, in this case, I was guaranteed a profit. Here's another example. This is TJX, the retail store. Bought 2,000 shares at $30.48. That's a split adjusted, and then bought the 40 strike put at $249. So we like to buy the at the money puts to protect our profits, and that enabled me to lock in a $14,000 profit on this trade. And again, bought the stock $30.48. Bought the 40 strike put at the money put at $249. If the stock is flat at option expiration, I get a 29% return. And if the stock goes up 40%, I still get 29% return. But look what happens if the stock really tanks. I'm still going to get a guaranteed return. So buying that put allows us to lock in a profit, and allows us to use our money management rules of not exiting a trade, a winning trade, with a small gain, and then our third money management rule of protecting profits by using options. So that covers the two types of stock spread trades. Now let's look at option trades. We have two types of spread trades for options too. And first we'll look at the option trade selection. This is the trade selection we use to select a directional trade in an option. And Um, in our trade selection, contrary to what you may have learned, option trading doesn't have to be complicated. Our mantra is to keep it simple. Options are derivatives, and they derive their value from the price movement of the underlying stock. So call options profit as the underlying stock moves up in price, put options profit as the underlying stock moves down in price. And it's really the price movement of the underlying stock that determines the option's value and the resulting profit or loss for an option trade. So when we trade options, we're just looking, if we're buying a call option, we're just looking to buy a call option on a stock that's moving up in price. And if we're buying a put option, we're just looking to buy a put option on a stock that's moving down in price. So we don't get involved with all the Greeks in all those mathematical formulas that are out there for option trading. We simply follow the trend, and we buy call options on stocks that are moving up and buy put options on stocks that are moving down. So if you can select a stock moving up in price using our directional trade selection process, if you purchase a call option on that stock moving up, that can produce profits as you harness the leverage that's provided by option investing. And we'll show you some examples of that. We used our simple trend following system for many years, and as I mentioned earlier, it works in both bull or bear markets. So if the stock is moving up in price, then that stock's on a buy signal. If the stock's moving down in price, the stock is on a sell signal. And of course, we buy call options on stocks that are on a buy signal, and we buy put options on stocks that are a sell signal. So that's all there is to it. It's pretty simple. We don't get involved in complicated mathematical theories and equations. We just simply buy call options on stocks that are moving up. So it only takes a minute to pull up these indicators on the internet to determine if you have a buy signal or not. So again, when we use a trend following system, that allows us to follow the current price trend instead of trying to predict the future price movement. And again, that eliminates emotional decision making and instead gives us the discipline to be successful option traders. And again, in the 2002 and 2008 bear markets, we owned bearish positions, and we were very profitable during those bear markets. So our prime trade.
Sorry to interrupt again. I just want to let everyone know, and you as well, we're approaching 45 minutes, and I know you have a lot more information to get through. So for those of you, I know there's a lot of questions that are going unanswered at this point, but I want Chuck to get through his material. So I apologize for this, but we'll try to just focus on the rest of Chuck's presentation with the limited time we have. Thanks.
Okay, sounds good. Okay, for prime trade select, for selecting a directional option trade, we use the 50 and 100-day EMA to determine the price trend. Then we use the Keltner channels to select a low-risk entry. And then the third step for an optional direction trade is what we use what we call the 1% rule to select the option strike price. And I'll show you some examples of that. So the first step is we want to determine the price trend of the stock using the 50 and 100-day EMA. And if the 50-day EMA of the stock is above the 100-day EMA, then that stock is on a buy signal, and we want to buy call options. If the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal, and we want to buy put options. And let's look at an example. This again is an example of a buy signal using the 50-day and 100-day EMA. And the blue line is the 50-day EMA. It crossed above the red line. At that point, Starbucks stock was on a buy signal, and we want to buy call options. So as long as this blue 50-day EMA is above this 100-day EMA, we want to buy call options on the stock. And here's an example of the sell signal, the FXI, the blue 50-day EMA crossed below the 100-day EMA. So that ETF at that point was on a sell signal, and as long as the 50 days below the 100-day, it remains on a sell signal. So we use the Keltner channels to select a low-risk entry point. And as we mentioned, the Keltner channels are overbought, oversold indicator. And when the price of the stock is trading near the upper channel, it's getting overbought, and it normally retraces. We can see overbought, retraces, overbought, retraces, overbought, retraces. And so we don't want to buy a call option when the price of the underlying stock is trading near this upper Keltner channel. We want to wait till it retraces to the middle channel or the lower channel to select a low-risk entry point. So we don't want to buy when the stock is trading near the upper channel. We simply want to wait till it retraces to this middle or lower channel when it's getting oversold, and then buy the call option, and that will allow us to get a low-risk entry. And here's some actual examples. These were option trades that we took, and these stocks were on a buy signal. The 50-day EMA was above the 100-day EMA, and then we waited till the stocks retraced towards the middle or lower channel before we entered our call option. So here's an example. We bought the XLU. You can see was on a price uptrend. The price, daily price here is the red and black vertical lines going from lower left to upper right, so obviously on a strong price trend, so price uptrend. So the question is, where do you jump in if you want to participate? And we waited till the stock retraced towards the lower channel here, and then we bought the 42 strike call right here at 630. So XLU, strong price uptrend, waited till it retraced, entered by buying the 42 strike put, and then you can see that allowed a low risk entry as the stock went on to rally. Here's another example, the B&Q Real Estate Investment Trust, again on another strong uptrend, got overbought up here. We waited till it retraced and bought the 70 strike call at 1334. This is DVY, the dividend index. Another strong price uptrend, as you can see by the daily price movement. Waited till it retraced to the middle channel and bought the 70 strike call at 1170. Here's another example. This is Amazon, another strong price uptrend. Waited till it retraced to the middle channel and bought the 330 strike call at 113. So here's a couple more examples. SSO, the leveraged ETF, S&P 500 ETF, waited till it retraced here, bought right in here, 65 strike call at 36, and then it continued to rally after that point. So the Keltner channels in these examples resulted in a low-risk entry as the stocks didn't retrace much from the entry point. So once we decide to buy a call option, there can be hundreds or even thousands of option strike prices to choose from. So we have a very simple rule of thumb, and that allows us to select an option strike price that has a good chance of being a winner. And we use what we call the 1% rule, and we want to limit the time value portion of an option to 1% of the stock price in order to break even on the trade. So option premiums, of course, consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you always want to be aware that you're buying a decaying asset, because each day it's going to lose time value until you get to expiration, and then the option will lose all time value. So you always keep that in mind when you're buying an option, that you're buying a decaying asset. So with that in mind, we want to, when we buy an option, we want to minimize the time value, because that's going to decay to zero, and we want to maximize the intrinsic value. And the way we do that is we limit the time value to less than 1% of the stock price. And if you do that, that will minimize the time value and maximize the intrinsic value. And let's look at an example here. If you buy a stock and it's trading at 100 and you want to limit the time value to 1% or less, then the time value portion of the option should be 1 point or less, which would be 1% of the stock price. So we'll look at an actual example here. So if you limit the time value portion of the option to 1% of the stock price, then the stock only needs to go up 1% in order for you to break even on the option trade and start making money. So that's not much of a movement, 1% move in the stock in order to break even on the option trade and start making money. So this will have, if you use this rule, you'll have a much higher probability of being successful than an option strike price that requires, let's say, a 6 to 10% increase in the price of the underlying stock to break even, which may never happen. And if that doesn't happen, then you're going to lose 100% of your premium. So we like to buy the in-the-money call options with that limits with a limited time value of 1% of the stock price. Okay, let's. And I just wanted to mention those examples of option trades that we took in the dividend index and the utilities index and Amazon. When we use the 1% rule for all those option strike prices. So all those stocks and ETFs, they only had to go up 1% in value after we bought that option in order to break even and start making money. So let's look at an actual example here. We bought the dividend ETF 70 strike call at 1170. DBY was trading, the stock was trading at 81.38. So this was an in-the-money call because we bought the 70 strike call at 1170. So stock price 81.38 minus the strike price of the call gives us an intrinsic value of 1138. So the option premium, we paid 1170. If you subtract this intrinsic value of 1138, the time value is only 32 cents. So DVY only had to increase in price 32 cents, and this call would break even and it would start making money. And we also have an option calculator for call option purchases, and this will calculate the profit potential for the trade, assuming various price changes in the underlying stock, in this case from a 30% increase to a 5% decrease. So DBY was trading at 81.38. If the stock was flat at 81.38 at option expiration, we'd only have a 2.7% loss on the option, which is a lot better than 100% loss. So if you buy a call option and the stock doesn't increase above the strike price of the call, then you lose 100%. So in this case, we bought an in-the-money option. If the stock is flat, we only lose 2.7%. We can also see if the stock goes up only 10%, then we get a 66% return on the option. If it goes up 20%, we get a 136% return. So even though we're buying more expensive in-the-money calls, the stock doesn't have to go up that much, and you'll realize a good return. So in this case, DVY only had to go up 32 cents or 0.4%, and this trade would break even and start making money.
Chuck, just so you know, we got about 5 minutes left if you can try to work your way through it.
Okay. Okay, let's look at the first type of option spread trade, and the Prime Trade Select has produced a lot of winning trades. So what we want to do is, of course, if we have a winning trade, we want to buy a put option to help protect those profits. And so if we use our option directional trade selection and we have a profit in that call option, then at a later date we want to buy a put option, create a spread, and this helps lock in the profits of our trade, and sometimes it can even guarantee a profit. So if we create these spread trades, you could have a severe sell-off in the market and you'll still profit on your trade. So we call these market neutral spreads because the call option, of course, profits as the underlying stock moves up in price. The put option profits as the underlying stock moves down in price. So we call these market neutral trades, and we'll look at some examples of market neutral spreads. And here's one for Cigna, and you can see we in our brokerage account we bought the Cigna September 70 call, and we paid $188.5 for that. So we bought we used Prime Trade Select to select this 70 strike call. We paid $188.5, which is $188.50. So we bought the Cigna 70 strike call at $188. Cigna went up in price. The underlying stock went up in price. It only had to go up 1%, and we're going to break even. It went up a lot more than that. So we wanted to protect those profits. So what we did is we bought an at-the-money 77.5 strike put. So again, bought the 70 strike call at 188 and bought the 77.5 strike put at 161. So once we bought that put, that created an option, a market neutral option spread trade for Cigna, and we'll take a look at the risk profile for that. And we actually have a calculator for market neutral trades, and we can see again we bought the Cigna stock at the time was trading at 77.72. We bought the 70 strike call at 188, the 77.5 strike put at 161, and this will calculate the profit potential assuming various price changes in Cigna stock at option expiration. In this example, from a 20% increase to a 100% decrease, and we can see if Cigna stock was flat at 77.72, we'd realize a $422 profit on the spread, 120% return. And by buying that put, it doesn't limit the profit potential. So if the stock goes up 10%, we have a 342% return. If it goes up 20%, we have a 564% return. But also, if the stock were to go down substantially, let's say it dropped 20%, the spread would produce a $1,182 profit, 337% return. And we wouldn't anticipate that it would drop this much, but we just put that in there just to illustrate that even if it dropped 100% to zero, we'd realize a $7,400 profit on the spread. So these market neutral spreads can profit if the stock's flat, and that would be the minimum return, by the way, would be the 120%. If the stock starts declining, our profit potential increases. If the stock starts increasing, our profit potential increases. So this is a great way to trade options, and once you put these trades on, you can just forget about them until expiration. You don't have to monitor the markets because you've already locked in a guaranteed profit on your trade. So it's a great way to trade options. Let's look at one more example. This is the Home Depot, and we use Prime Trade Select to buy the Home Depot 80 strike call. We paid $10.15. We got a low risk entry. The stock went up in price, so we had a profit. And then we bought the at the money put, the 110 strike put at 420. So we bought to open 45 of the 110 puts at 420. And let's look at the risk profile for this spread. Home Depot was trading at 115.17. Bought the 80 strike call at 10.15, 110 strike put at 420. If the stock was flat at option expiration, we realize 145% return, $2,082 dollar profit on the spread. And if the stock goes up in price, then our potential on the spread keeps increasing from 225% for 10% increase to 305% return for 20% increase. And then, of course, if the stock goes down, we still profit. So in this example, we're locking in by buying that 110 strike put. We're locking in 145% return for the spread, or $2,082 profit for the spread. So here's one more example. We don't have time to go through this one. This is for XLV, but you can see that these market neutral spreads, it allows you to, if you have a profit on your directional call option trade, you can actually guarantee a profit by buying a put option. And there's one more option spread strategy I can talk about here, and it's option debit spreads. We don't trade the credit spreads. We trade the debit spreads, and we follow our money management rules. If we have a profit in a directional call option trade, then we can sell a call option with a higher strike price to create a debit spread. And if you purchase a call option, you have a profit, and you leg in at a later date by selling a call option. When you sell that call option, you increase the profit potential of the existing option purchase, and you also provide downside protection in the event the underlying stock decreases in price. And of course, the call option that you purchase will profit if the price of the stock increases, and the call option that you sold will profit if the price of the stock decreases. Your risk is limited to the cost of the spread. Here's an example for XLU. We bought the September 42 strike call. We paid $474. So bought the 42 strike call, $474. We had a profit in this trade. XLU moved up in price. We used the 1% rule to select this strike price, and we had a profit in this trade. So at a later date, we sold the 48 strike call. So bought the 42 strike call, 474, had a profit. So we sold the 48 strike call at 190, and when we sold that at 190, then $370 in cash income went into our account. And the selling the 48 strike call at 190 actually increased the profit potential of our 42 strike call purchase. And the sale of 48 strike call also provided downside protection if XLU declines in price. And we have a call option spread calculator for debit spreads. And again, you saw from the brokerage statements, we bought the 42 strike call at 474, sold the 48 strike call at 190. At the time, XLU was trading at 50.32. So let's look at the risk profile for this trade. If the stock was flat at 50.32 at option expiration, in this example, we'd realize 111% return for the spread and $316 profit. So the cost of this spread by buying the 42 strike call at 474, selling the 48 at 190, the actual cost for this spread was $284. So if the stock is flat, we have 111% return. If the stock goes up at all, we would have 111% return, $316 profit on a $284 cost. And if the stock goes down, we can still profit. If it goes down 5%, we'll still have 104% return. If it goes down 7.5% at expiration, we'll have a 60% return. Here's one more example.
Chuck, I'm sorry to cut you off. We're already over an hour.
Okay.
I think we gotta probably just wrap it up and scroll through to your to your contact info because I'm sure people have a lot of unanswered questions.
Okay.
And unfortunately, we weren't able to get through everything today. But if you don't mind putting that up so they can reach out if they have any questions for you.
Okay.
And again, I'm sorry that we ran into this time crunch. Unfortunately, my hands are tied with the time limit. I've already pushed it over as much as I could.
Okay, no problem. Here's the information if you want to contact us